This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to episode 32 of Value Investing. Of the last 3 episodes, we talked about 25 golden rules by Peter Lynch. And as I mentioned in those episodes, Peter Lynch was a mutual fund manager who was able to average 29.2% annual return from 1977 to 1990, consistently more than doubling the S&P 500 market index and making the best performing mutual fund in the world. So I wanted to know everything about Peter Lynch, so I have gone through 25 golden rules of investing by Peter Lynch. And as I mentioned, there were a lot of overlapping areas between Peter Lynch and Warren Buffett. It's not just a coincidence, it's because a lot of these legendary value investors share the same sort of wisdom with each other. So what I want to do on today's show is to talk about how Peter Lynch identifies undervalued banks in the stock market. In the past episodes, I talked about banks in an extensive manner, so I highly recommend that you go back and review those episodes. But here, what I want to focus on is how Peter Lynch identifies undervalued banks and what kind of criteria he uses. So I'm going to go over 8 criteria that Peter Lynch uses when it comes to identifying undervalued banks. All of this information is written in the book called Beating the Street by Peter Lynch. And I'm going to include a link in the show note so that if you want to buy from Amazon, you can just go there and buy. The price is very affordable, so I think it's definitely worth it. But even if you don't want to do that, it's fine because I'm going to go over them here in detail on my podcast. Before I get started, let me give you a quick disclaimer that this podcast is for entertainment purpose only, and it is your responsibility to consult with your investment professional for any investment decisions. So I'm so excited to go over the criteria, so why don't we get started? Before I talk about the criteria, what I want to do is I want to go over the high level of how banks make money. So it's very simple business model. So let me just try to explain to you. First, the banks have to take deposits from individuals just like you and me, and they provide very low interest rate. So that's why you see very low interest rate on your checking accounts or savings accounts. Once the banks take these deposits from various people, what they do is they lend this money to various businesses and even individuals. So you can buy a house and you need a lot of money, you borrow money from the banks, but you have to pay high interest. And also banks lend the money to various businesses. Depending on the risk profile of the businesses, the banks charge different interest rate, and based on the gap between how much the bank charges on businesses and individuals versus how much they pay to the depositors, they can make money based on this gap. This is called interest rate margin. So that's a simple explanation of how banks make money. And if you look at bank's balance sheet, which is quite important, deposits are listed as part of liability, and loans the banks make to businesses are listed on the asset side of the balance sheet. So it's important for you to understand these 2 items in detail when it comes to investing in banks. So why don't we just talk about Peter Lynch's investment criteria for the banks? Okay, so the first thing that Peter Lynch checks when it comes to finding out undervalued banks, he look at initial offering price. He's basically saying that when the bank is selling below the price at which it came public, it's a sign that the stock may be undervalued. Other factors, of course, have to be considered, but it is a good starting point. I don't necessarily agree with Peter Lynch because I feel that the initial offering price is just there as a reference point, but in most cases, what matters is the current price versus intrinsic value. But as Peter Lynch mentioned in his book, this is just a quick thing you can check just to get a hint as to whether the bank stock is undervalued. You have to look at other factors, of course. So let's move on to the next one. The next one that Peter Lynch checks is equity to asset ratio. And this is quite important because this is the most important number of all. That's what Peter Lynch said in his book. It measures financial strength and whether or not the bank is going to survive in the future. The way you look at this number is that the higher the better. It ranges from as low as 1 or 2 to as high as 20. So there's a huge variation in terms of this ratio. So on average, you'll see 5 to 6. That's the average number you'll see when it comes to looking at the banks in the United States. If the ratio is below 5, you don't want to go nearby because it's dangerous. So let's just try to understand what this ratio represents. You look at equity number divided by asset number. The reason why this number is important is because you want to have some equity cushion in case of potential loss in the future. Otherwise, you're not going to be able to survive as a bank, and your losses will wipe out the equity. You're going to go bankrupt. You're not going to have enough money to cover the loss. So you want to have sound bank in your portfolio, and you want to check this number. And also the high ratio is not only for disaster protection, but also because the bank can become an attractive takeover candidate by other banks. So this is also considered untapped lending opportunity. So for example, if there's a bank, let's say a big bank trying to make an acquisition, probably the first thing they look at is equity to asset ratio, because if equity to asset ratio is very high, let's say 20, then there's untapped lending opportunities. The big bank can acquire this small bank with high equity to asset ratio and lend more money to make more money. Literally can lend more money because of the high equity cushion. The rule of thumb for this equity to asset ratio is that you have to invest in banks that have higher than 7.5 equity to asset ratio. One other thing that I want to mention here is that you also might want to look at common equity tier 1 ratio. And this is something that I discussed in my previous episodes when I talked about banks. But Peter Lynch didn't really mention in his book, but I think that it's important. It's very similar to equity to asset ratio. When you calculate equity to asset ratio, it's very simple. You just go to balance sheet and take equity number, total equity number, and divide it by the asset. That's as simple as that. But the way you calculate common equity tier 1 ratio is different, and it's already there for you because a lot of these banks are regulated by the government agencies, and they have to calculate common equity tier 1 ratio, which is calculated as common equity tier 1 capital divided by risk-weighted asset. And common equity tier 1 capital is similar to equity from equity to asset ratio. But common equity tier 1 capital is the best capital out there from equity perspective. So equity can be divided into different categories, and you can think of this common equity tier 1 capital as the best equity capital that can absorb losses in the future. And also, if you look at denominator, instead of using asset, you use risk-weighted asset, which is basically calculated by taking into account the risk on the balance sheet. So instead of taking just total asset number literally from the balance sheet, the bank has to calculate risk-weighted asset, which means if the bank has a lot of high-risk asset, they have to do the multiplication in order to increase that number. And if the bank has only treasury bills or treasury bonds, which are considered very safe, the bank asset size is going to be very small. So it adjusts based on risk by applying risk weight on different assets that the bank holds on its balance sheet. I would say that you need to have at least 7 for this ratio as well, which is quite similar to equity to asset ratio. But you look at these two ratios, I think that should be enough to check whether or not the bank would go bankrupt in the near future. Let's move on to the next one. The next one that Peter Lynch checks is dividends paid by the banks. And he prefers the banks that pay high dividends. And high dividend is always a plus sign. Obviously, this is not just for the bank stock investments. It's for any investments that you're making. Because this is the money, actual money, the company is paying out to its investors. And there's no way the company can fake dividends, because in some cases, if the company is trying to manipulate their financial statements, they can do so using various techniques. But dividends are actual money coming out of the corporation into your pocket, so they can't do that. So also dividends can function as the supporting line for your stock, because if dividend rate is high, dividend yield is high, then the stock tends not to go below certain supporting price because of dividends. Okay, so let's move on to the next one. So next one is a book value. As with other investment, it is important for you to look at book value for the banks, but it is more important. The Peter Lynch said that book value is an accurate reflection of the bank's real worth if the bank has avoided high-risk lending. So the rule of thumb that you can have here is to find banks with book value that is below market valuation of the bank. So why is it important for you to look at book value for the bank investments? Because if you look at asset side and liability side of the balance sheet, you'll see why. Because the asset side of balance sheet can be broken into 4 components for the banks. First component consists of cash investment securities, which can be liquidated very fast, and you can consider them as cash. The second component is loans that the bank has made to various places. And as Peter Lynch mentioned, if the loans are composed of less risky segments, then you can get a lot of these loans back with principals and interest. So it can be also liquidated over time easily. The third component is real estate owned. And I'm going to talk more details later on, but this is the real estate that the bank has already foreclosed. And the bank can sell these real estates over time, so it's a real money. And the fourth component is fixed assets. And a lot of times, if you look at manufacturing companies, they have large portion of fixed assets, but banks have very light on fixed assets. So you don't have to worry too much about that. The last part is goodwill, intangible assets. And if you look at various banks, they may not have this goodwill if they haven't purchased or acquired other banks in the past. So you have to also consider goodwill when you look at the book value. And if you could move on to the liability side, mostly it's composed of deposits from depositors. And this is the real liability that the bank has to pay to these depositors upon the decision of liquidation. Okay, so the bottom line is that a lot of items on the asset side of the balance sheet and the liability side of the balance sheets are marked to market on the balance sheet, which means upon the liquidation of entire thing, asset minus liability will give you very good idea about how much leftover is going to be after the liquidation. And it's important. If for whatever reason, if you want to assess the value that equity holders have, the book value represents really good measure. Okay, so let's move on to the next item that Peter Lynch checks when it comes to identifying undervalued banks. He looks at P/E ratio. I think there's no explanation needed for this ratio because I assume that a lot of you guys, if you're familiar with investing, this is the first ratio, and it is very important ratio that you have to look at for any investment decisions. Some banks have P/E ratio of 7 or 8 based on the prior 12 months earnings with annual growth rates of 15%. Then that's a really good bargain. The rule of thumb in this case is you want to find banks with P/E ratio below 11. So let's move on to the next one. Next one is high risk real estate assets. So this is the problem areas for a lot of banks. Banks make loans to construction developers and commercial business people. And these are very risky loans because think about construction. The bank can make loans to them and it takes about more than 3 years in order for the developer to build the building and getting some cash out of that building. So if whatever goes wrong on the construction project, the developer can easily go bankrupt and banks has to take the hit. And usually these loans are very big in size, so very risky, and you don't want to see high percentage here. If percentage of high risk real estate asset goes above 5%, Peter Lynch said that he's going to get nervous. And if it's more than 10%, he's going to stay away from those investment opportunities. Obviously, the smaller, the better. In terms of calculation, you may not be able to get this number right away. So the way you can do the proxy calculation is by taking the dollar value of construction loans and commercial loans on the asset side of the balance sheet and divide them by total loan amount from liability side of the balance sheet. Then you can get a good proxy for this ratio. Rule of thumb for this ratio is that you have to find banks with this ratio below 10%. Okay, so why don't we move on to the next one? The next one is item called real estate owned. And I briefly mentioned in this episode, but let me just go over quickly. This is the property on which the bank has already foreclosed. This category is an index of yesterday's problems because whatever shows up here has been written off as a loss on the books. Since the financial hit has already been taken, high percentage of real estate owned isn't as worrisome as high percentage of non-performing assets. But it is worrisome when it is on the rise. That's what Peter Lynch said. So as he said, when you look at this item, instead of looking at the size of this item because it's already been written off, you don't have to worry about it because it's yesterday's problem. You have to look at the trend, whether or not this percentage is trending up or trending down relative to total asset size. One thing to highlight is that the banks are not in the business of real estate. So if the banks have a large portion of their asset tied to these real estates, then it is a good sign that it is getting into trouble. They have to get rid of these assets as soon as possible since they incur a lot of real costs to the banks. For example, the banks have to pay taxes, they have to pay maintenance fees, and there are just so many fees associated with owning real estate, and that's not what bank wants to do on an ongoing basis. The rule of thumb in this case is that you want to find banks with real estate owned item less than 1% of total asset. Finally, let's cover the last item, which is very important, 90-day non-performing assets. These are the loans that have already defaulted. You want this number to be low preferably less than 2% of total assets. And second, the trend has to be downward, not upward. An extra couple of percentage points worth of bad loans can wipe out the entire equity. So as opposed to real estate owned, which has been already written off, this item has not been written off in the past, so it's going to take directly hit on income statement and your equity. So equity can directly be hit by this item, so you want to be mindful of this item trending up. And also, you have to be mindful of the size of these non-performing assets. Again here, let me give you a rule of thumb by Peter Lynch. He said that you want to invest your money in the banks with 90-day non-performing assets less than 2% of total assets. As you can see, bank investment is all about risk management. You want to make money from these investments, but what you want to be careful about is that you want to invest in the banks that manage the money in a conservative manner, because the bank's business model is highly leveraged. So one small mistake can wipe out the entire equity portion of the balance sheet, which is yours as an investor. If you want to protect your equity portion of the balance sheet, what really matters is the risk management, and you want to see good risk management practice from these different banks. And if they can manage the risk well, then you're going to be rewarded handsomely in the future. Okay, so that's it for today's show. So on today's show, we talked about 8 different metrics which you can use as a reference in order to find undervalued bank opportunities in the stock market. Initial offering price, equity to asset ratio, dividends, book value, P ratio, high risk real estate assets, real estate owned, and finally 90-day non-performing assets. What I'm going to do is I'm going to include a summary of what we have discussed in the show note, and I'm going to also put the thresholds below which you want to see these numbers in order to find undervalued bank opportunities. I hope you enjoyed this show, and before I end, I just want to remind you that 5-star review always goes a long way on whichever platform you listen to this podcast. Thank you very much, and see you next time.